Hello and welcome back. After we examined our first stock in the series of ARK ETF Trust, we did examine Tesla already. Now we're gonna jump to ROKU, which is about 6.59% of the weight inside the ARK Innovation ETF of CATHIE. So, what's going on with ROKU here? Let's take a little bit of a closer look. And again, we want to examine all the core holdings that ARKK consists of right now, just to see whether these kinds of companies are good to hold, are nice holdings for our portfolio. Because obviously an ETF is a collection of stocks, and so we want to examine at least the core holdings very well to see what their underlying finances are, and this is what we're doing in this video. So the outstanding shares of the company ROKU here are increasing and keep increasing over here since 2018. So this is not too many years really, and this has increased about 40% or so. This is a steep increase, and I guess the company was trying to take advantage of the higher prices, as a lot of these companies are doing. However, the big problem is that at some point reality comes into play, and right now the stock is actually down almost 65% here, which is massive. It's a massive decline, and I'm sure it's one of the very big reasons why the ARK Innovation Fund has actually really declined here. Yeah, this has dropped a lot. It used to be like 500 almost. Now, regardless of the drop, sometimes drops are, can happen and it doesn't really matter. We want to be examining what the company is doing financially, because that's what matters. Sentiment can change, a lot of companies can drop in price, but what are the underlying financials? This is what we care about, really. So, I'm going to take a look at the last 5 years. This is obviously a pretty new company as well. And the good thing, year-over-year growth that the company is enjoying is pretty considerable here, and so the revenues are increasing, meaning that the company is able to sell a lot of product or services, really. And likewise, the gross profit very nicely increasing as well. So these are very positive signs here. But what about the net income? The net income of the company just is barely positive right now. It used to be in the negative, and the last 12 months, maybe that has a lot to do with the pandemic as well. But it has increased, and it's about 300 million right now. So barely positive almost for ROKU. What about the balance sheet? And we did already examine that the company has been selling a lot of stock, so you will see that reflected here too. And two things that I want to examine as usual. The liabilities, the total liabilities sitting at 1.2 billion. That's not much, and that's pretty good to see actually. And the total equity being at 2.6, so it's almost double the total liabilities. Okay, and the total equity also increasing very nicely from 150 million back in 2017 to 2.6 billion. So that's a steep increase, but I guess that has a lot to do again with the cash flowing from investors, because you will see it here. Additional paid-in capital is money that was spent by stockholders. 2.8 here, 1.6. So the company has been selling stock, has been selling a lot of stock just to fund themselves throughout the period where the company's stock was doing awesome and was like almost 500. So they got a lot of money out of that operation. Cash flow. The cash from operations here is positive, so the company is making some money. That's good. And the cash from investing in the negative, which is normal and expected. There are a few acquisitions here. What about the cash from financing, which is interesting? So issuance of common stock, yeah, what we examined earlier. And this can be a very big killer for investments. And people may be thinking that in some situations they are buying stock from other investors, but in many situations, and especially here, for instance, they're actually buying stock from the company itself, which is issuing more and more shares into the open market. And this can be very problematic because it dilutes current investors, previous investors really, and also the current ones are getting a very high price for the stock. So be cautious about this kind of situation here. This is why we're examining the outstanding shares. It's massively important that the company doesn't really dilute you. So what about the free cash flow? 28 million here, a little bit of a loss, and then 65 and 266 $1 million. The multiples of the company are sitting at 8.5 here. This is a little bit expensive. You typically want to see it at around 3 or less, even if possible. This is a little bit of an expensive company. At least it's less expensive than when it used to be, when it was like super expensive here, and then it went down, it crashed really. And return on equity for 14% is relatively low, but this can be skewed really, so I don't pay too much attention. And the total debt to equity 20%. This is healthy. And yeah, this isn't problematic at all. But again, you have to bear in mind that the company's equities has a lot to do with the stockholders buying stock. And so you have to always acknowledge that. And at least the company didn't have too much debt. We saw that total liabilities were like 1.2 billion. So that's fair. That's absolutely fair. And the thing that I want to examine, as I usually do, is the free cash flow when you compare it to the price of the stock price. And currently we're looking at a company that, let's just say it's making $200 million here, and with a multiple of 20, which is a relatively high multiple, but you can definitely make a case here for for growth for sure. And at times you may even want to take it to 25. I mean, it really depends on how the company is growing. This seems like a high growing company, so I'm fine to pay a little bit more, even 25. If we calculate it with a 25 times multiple of its free cash flow and a $200 million average, we're getting about $5 billion, right? In terms of the market cap of the company. And so the current market cap is sitting at 22, which is almost 5 times more than what we'd want really here. And this is also reflected in the forward PE. This is why you're looking at the forward PE, which is 150. So even though the price of the stock has actually fallen off a cliff here, like 65%, I still consider this expensive for buying at these levels. Frankly speaking, I would want to get it maybe at around here really. Because maybe a little bit more, like maybe here even, like 70, 50 or 70. Even 70 could be a little bit expensive really. Again, based on what we are looking at on the financials of the company, and you may want to pay a little bit more just for the company's potential growth. But this is what I'm seeing here, and also the fact that the outstanding shares keep increasing, and they are still rather low. They're at 134 million. This company doesn't really, give me any confidence that they won't keep increasing their outstanding shares and dilute me. So I wouldn't get into that one here. And this is one of the core reasons why the ARKK fund has really dropped lately. ROKU is definitely one of the big reasons here. All right, so let me know what you feel about ROKU. Do you own the stock? Do you plan to buy it? What do you think about it? And if you did enjoy this video, please leave a like and subscribe. You can also take a look at the previous one that I made about Tesla, and this is again about the ETF ROKU, the ETF fund, and ROKU is the second holding. So I did make a video previously about Tesla. You can find a link in the video on your screen right now, and you may want to join our Discord also. Link on the description box below. See you in the next one. Bye bye.